Are 10% mortgage rates coming near you in the near future? Let's talk about it. So I've been reading a lot lately about and other YouTubers are saying, "Oh my gosh, you're gonna have a 10% mortgage rate. Is that a possibility?" So I did some research and I couldn't really find uh, if that is true or not. But I asked, ChatGPT and AI a little bit and asked it to make a prediction. I know this is AI, so this isn't a super official statement, but if you know, and if you think mortgage rates are going to hit 10%, let me know in the comments below and let's see what you guys think. And I'm going to give you my opinion if that might happen or might not. So I asked AI, hey, take these stuff into consideration. And I gave him some data. And I said, predict if mortgage rates are going to be 10%. And it gave me a nice little wording right here that said, I give it about a 5 to 10% chance of mortgage rates actually hitting 10%. So I was looking at it like, okay, that's a pretty high prediction. Like I would have thought it would say something like 3% or 1 to 5, but it said actually 5 to 10. I think that's pretty hefty. So I was looking at it like, oh my gosh, 10%, that would ruin most real estate investors. And you might be like, why? So if 10% mortgage rates are going to happen, that would decrease housing affordability. Higher mortgage rates means higher monthly payments. So I ran another test, kind of like it, to see how much it actually will go up. So from 4% to 8%, the payment would increase. You see it right here, about $800. That's before taxes and whatnot. So it is crazy to see the 10%, from 4 that it was a few years ago, or I actually have a 3% market. So if you have a 4% interest rates, you get the golden handcuffs. You cannot sell. That is not going to happen to you. You cannot leave your house for a nicer one, upgrade, because you're stuck. And the cost of borrowing capital is going to be so significant at 10% that it's going to hurt a lot of people, including me, because I also have rental properties. And this is going to be really, really bad because a borrowing cost, the demand of homes may decrease. Yeah, it could result in cooling of the housing market with slower home prices. Yeah, because nobody can afford it. So if you want to actually buy a house and live in it, and you just increased by $800 a month, the payment just for the mortgage, that's a lot of money. So for an average American making, $60,000 a year, that is about, $8,000, $9,000. That's a pretty hefty price for a same house. So that would mean that you need to sell your house now and actually take a price cut because people cannot afford it. So that means your appreciation is pretty much gone if you want to move or do things. So yeah, the cost of capital is so much more expensive. Increased borrowing costs for homeowners. Homeowners have to adjust to higher. Looking for a refinance would face higher costs. Yeah, refinancing is pretty much done. And if you're a mortgage lender, let me know in the comments to see if you're still doing refinances. I've seen some on TikTok and other social media platforms that they're saying that they still do refinances because some have high credit card debt and then they pay off the credit card debt and then they have a higher interest rate. Because when you have like a lot of credit card debt but a low mortgage payment, it might be really smart to refinance your house at 8% and take that into consideration rather than paying 29% interest on a credit card, right? So you basically cut down 20% on interest depending on how much debt you had, but it shouldn't have not come to that in the first place. But as you see, the economy's not doing so great right now, and we're going to have if we're going to have mortgage rates in the tens, that's going to put a lot more businesses out of business because the cost of borrowing capital is so high and it's going to be detrimental. The impact of construction and real estate. Yeah, with declining home sales, the constructions of real estate sector could see reduced activity potential. Yeah, would lose slower growth. Yeah, so if you're a developer or something, if there's no demand out, you either have to lower the price and build cheaper, or you're going to have somebody like BlackRock or one of these huge ass investment firms that are going to actually take that they're going to buy your house and then they're going to be just rentals. I've seen people in the comments saying that that's where we're heading towards, and that some of these homes, even in Las Vegas, in my area, are not going to be for sale. They just hit the market as rental properties because they don't want you to own anything. They just want you to be a renter nation. Um, that might be the case, but might not. If you have the dream of buying, you should still consider buying, just because if that's your dream, you should 100% do it. But if you're, if you're savvy with money, I don't know if it's worth it, because as people are going to move out of the housing market and they're going to leave real estate investment behind, there's going to be other opportunities. Maybe in the real estate sector, stocks or something else are going to pop up and you'll find other investment opportunities, right? Potential increase in defaults and foreclosure. This is a huge one, because with higher interest rates, all these people that didn't do a fixed rate are going to get seriously, seriously hurt. And I'm not like saying that's gonna happen. I already see it happening. Like with foreclosures up, they're not, I think, correct me if I'm wrong, but I don't think they're up to pre-pandemic levels, because I think mortgage rates were so low around that time that people just locked in their super low rate. And I would actually not pay anything else besides my mortgage. So I would default on credit cards, car loans, everything else before I let my house go. So I think foreclosures are just the worst thing that could happen to you. And yeah, this is just not good. So yeah, higher interest rates often slow economy growth. Expensive mortgage rates can reduce consumer spending elsewhere, potentially slowing the economy. Yeah, so another thing that I think is really interesting, if you take, that's why I was so for kind of for student loan forgiveness, so that that money would go back into the system. That $500-600 a month from these people would go back into the system. But now that we forgave that, and now they want to buy a house, it's like we didn't have to forgive it, because the money's not going to be in the system again, and the banks are going to gobble them up or something else. And I was really hoping that small businesses would get some of that cash, that they're going to be saving on mortgage rates or on on the student loan forgiveness. But now when you have to have student loan forgiveness, their money's gone, that they're like, hey, we wiped out your $30,000-40,000, so now you have $500-600 a month. Just really hoping that they would say, hey, spend it in your local, on your local small and pop business, pizza shops, arcades, whatever, your small and pop shop does. And so that they see prosperity from it. But now when you increase, you cut $600 there, but then you increase mortgage rate by $600-700, it's a net loss. Yeah, you don't have the student loan debt, but now you have super high mortgage payments and your house poor. Yeah, you might own a house and it might come down in 10 plus years or something, and you can say, I can refinance and do stuff later down the road. At least I'm a homeowner. But it didn't really help the economy out, and it did really help out, get the economy back going and all that kind of stuff. So it's kind of sad to look at it. Okay, let's look at the rent market. If few people can afford, there'll be demand for rentals, which could drive up the rental price, affecting housing even more. So if you're gonna, I think there's two sides of that. I think there's a side where, yes, that might be the case, where it's gonna drive up the rental market prices, but it might also increase the foreclosure side of small and pop landlords, because yeah, you might charge more, but who knows how many landlords had a fixed loan or had an interest only loan for 5 years. So when you deal with real estate, and I do that, there's many ways of creative financing. You can finance a property in so many ways. You can go to a hard money lender and then try to refinance it later. And I see a lot of people do that. They buy a fixer upper, have the contractor pay the cost of remodeling it, and then either resell it and then they get paid, or like a bunch of different ways how you can like creatively finance a rental property. And so once you creatively finance that and you can't refi, then you hurt everybody, because you're hurting yourself, you hurt the contractor, you're hurting because they want their money, so they put a lien on the property or something. So it's not a good way of playing around with debt as interest rates go up. So on the other hand, if interest rates go down, you can do fun stuff like that because the market will bear you out. Because if you wait a little bit, the market dropped. So when I bought my first townhouse, I locked in my mortgage rate at I think at 4.8%. And right when I closed, the mortgage rates dropped to 4.2. And I was like, so can we, right before we closed, like, hey, can we adjust this? He's like, no, we locked in your rate. And I was like, oh, bummer. That would have saved me some money on a $500,000 loan doing that. And so while I was sitting on my house, making at 4.8%, the interest rates were constantly on the decrease. So I was in that time, I think it was 19, where interest rates started to come down. And I see, they came down pretty rapidly. And I saw it like, oh man, this is 3%, this is, then it's at, I think, 2.9%. And then it came down to 2.8%. I was like, yep, let's refi. And so then we refied. And then I didn't live there long enough to actually make money on it because the refi also costs money. But the market kind of bails you out if you play if you play with debt like that. But on the other way, if you do the reverse thing and the mortgage rates go up, you're going to be hurt. And all these big commercial buildings, you see them in San Francisco. That huge tower that got sold for pennies on the dollars. Some of it might have to do with the economics of just San Francisco, but other stuff has to do with interest rates. So all these big players are going to have problems when their loans are due or when it's time to refinance, because some of these loans are 5 years, and then then the interest rates gets readjust and all that. And let me know if you have a fixed interest rate in your commercial property, or if you have a variable one after 5 years, they readjust it or something. Yeah, it's tremendous, because then all these mom and pop stores that you're renting out in commercial, it's also going to get increased because you need to you need to make a profit. And so the funny thing about that is that everything's going up, like I said, iced tea at the stores, like the Tazo tea is now $10 at Safeway. Used to be like $3.90. So it doubled so much. And I don't know why it's $10. I don't think anybody's going to buy it. So the market will demand the price. But there's going to be a pullback from all these people that say, I don't want to spend that kind of money doing things, or spend money, like that. And I still feel like America did such a good thing about marketing, about you being a homeowner, that they're like, you know what? You still need to be a homeowner, cost it what it want, right? Just get in and take the rate and refinance back later. But life stuff happens to you. You go into, your wife loses your job, then you get into an accident, and all of a sudden your house that's supposed to be an asset turned into a liability real quick. And people don't get that. People always think, oh, it's my neighbor that might happen to. And so when you're in a situation like that where you say, it's my neighbor's, it's my neighbor, not me. Thank God it could be you. And at one time, it's probably going to be you. And I've seen people in Las Vegas area that are saying, oh, my neighbor couldn't make the payments anymore, so she's trying to sell it, and there's just no offers, and it's not staying on the market, because people can't afford it. Because people are in hurt. The economy is not doing as great as they always proclaim to be. So it's a real crisis when mortgage rates are going to hit that high. Because if you're also a business, and and you refinance your loan, or you take out a loan to grow, or capital from VCs, they want to see a return. And so when the interest rates go down, the capital gets cheaper to borrow. So you can borrow more, and you can reinvest it. You can use it to grow the business. But if you can't do that because lending's tightened, and all of a sudden the bank says, nah, you can't refinance or move some debt around, do some creative financing, you got to pay it back to us. And all of a sudden you're like, oh shit. And so what do? You need to cut costs, increase profitability, to start paying that back. And I'm like, oh my gosh, that's going to hurt so many people. And it is just interesting to me because I know people are, they want to live their life. And I've seen comments on my YouTube video that they're saying, oh, everybody around the world doesn't live on credit, but, America does. Yeah, it's a different system, We run on credit. We run on credit lines. I'm surprised that your dog cannot take out a credit card because they ask you at Walmart, hey, do you want to apply for a credit card? They ask at Macy's, they ask everywhere. Everywhere you're at, they ask, do you want to take out a credit card? And all you need is a social, and then they're like, here, apply for the credit card right here, and we'll give you 20% off. So it's like an industry. And it's funny that they don't say, hey, you got your little pup with you. Maybe it wants to fill out the credit app too. And that's going to be detrimental. And these people during COVID that bought nice cars are going to be even more butthurt because they thought the funny money's never going to stop. And it did. And now they want to trade it in, or something happens to it and they're upside down. And I read an article that said 25% of people that now have negative equity are trying to trade it in and they can't do it. So congratulations. When you bought that new car because you got stimulus money or something like it, you just played yourself, because now you have a high payment. And if you do something to your car and your car, isn't worth that much. I've seen a guy online that said, I have a trade-in program. And he said he got so many where he's like, we get you out of negative equity. And he said, you can buy a cheaper car and we'll get you out. And so you can do greater things with your money, right? You can do, we'll get you a cheaper car, we'll get you out of negative equity, and you can then, spend the money elsewhere. So people called him and said, people call him with $30,000 on a vehicle that they're upside down. And now I'm like, how did that happen? Who allowed you to take out a loan and that you're upside down $30,000? I get if you're upside down $10,000, if you're upside down $6,000. I've been upside down $6,000 on a vehicle before. I just had to cover the difference in a check, write it to him, be done with it. But $30,000, that is a half a year's income that you're upside down. But America America, I feel like thinks, and this is not a way judgmental or anything, and I just see it a lot from somebody that grew up in Europe, that America just loves to think till the weekend. Oh, and I'd like to get a nice car, and today I can afford it, but I don't know what's tomorrow, so let me just buy it, or let me just finance it. And they make it so easy now, where you just go in, you fill out a credit app, they come back, they do things, like the sales office wants you to buy it, and then they just, jack up the prices and whatnot. And so these dealerships are going to be even more in the hurt because they charge people so much. And guess what? I kind of wish that they go out of business, because they screwed their own customer base over and they robbed them for years to come for their profitability. So what comes around goes around. You screwed these people, and now you're going to get screwed. And I really hope that the government does not step in and bail you guys out, because you guys screwed over all these customers. And these people that have $30,000, negative equity in their car, are then trying to buy a house or anything else, and they can't afford it. So congratulations. Your eagerness to buy a car during COVID just costed you your dream. Let me know what you think about that. But yeah, it is sad to look at how the economy is doing and how we let it come to that. Because, we have all these signs set up everywhere that says, oh, crossroad, it's dangerous. Oh, you can't swim here, there might be sharks. But nobody's at the finance office says, hey, are you really thinking about buying this Mercedes right now? At $20,000, $30,000 over sticker price, or at $5,000 over sticker price? Because most likely in some high-end cars you might, but in most other ones, it's going to be gone. That is all profitability for the dealership. So 10% mortgage rates are going to mean higher borrowing costs, and all the stuff that you've been doing or trying to do with money is kind of done now. And as inflation is still on the rise and there's not a pullback yet, it's going to be interesting. going to be really, really, really interesting what's going to be coming up. And I wish everybody, that we make it out of this before the next election. But yeah, I think that this year's on the economy, on the election, the economy is going to be the number one concern. It's funny because in 2016, when I looked at it, they had border crisis, health care, they ran about abortions and all that. And I feel like those are all nice to haves, but when you can't pay your bills, I don't think it's on the number one priority right now. I feel like we're struggling so much as the common Americans that that things like, the border crisis and whatnot isn't the biggest voting issue. I could be wrong. Let me know. But yeah, RV for sale right there. So every toys are for sale, and that's also another sign of an incoming recession. So during COVID, I saw 0 ATVs for sale on Facebook Marketplace, 0. Now they're scattered. Now you can pick them up cheap. Now you can get them way, way, way cheaper than you could. And RVs too, way cheaper now than you could have during COVID or during, where the stimulus money went around. So yeah, I think we're going to be in a buttload of hurt if we can't turn this around and somehow make it that everybody's going to be on the way to prosperity. And I know you can't get everybody out, but we need to at least get out the middle class and make sure that these people can spend the money again, go out to restaurants, support the local economy. And yeah, this is it for this video. If mortgage rates are going to come hit it, I personally think it's probably not likely, because that would just collapse the whole housing market, I feel like. Because 10% interest rates is going to make so many people lose money. But guess what? What happens with that? That means there's going to be great buying opportunities for you. And let me know what you think. If you watched so long, I really appreciate you. Please like and subscribe, and I'll see you in the next one.